Okay, here we go. Welcome, you're listening to The Best of Investing on Talk 910. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. And for those of you listening for the first time, because we have a lot of new listeners, here's our format. A few guys, or gals in this case, sitting around a bar having drinks without the drinks, talking business with you, the audience listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing private lender. Robert Spinoza of RPM Mortgage, and we welcome back Catherine Harris, CPA of Parati & Karad. Our phone number is 888-912-1190. Write that number down, 888-912-1190, because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. You got it. We're giving away 9 vacations during this show. Today's trivia theme is colors. Be kind of fun.
Yes.
Okay.
Chartreuse.
Oh, okay. That was the answer to all the questions. Thanks a lot.
Primary.
You won all 9 vacations there, Robert. Okay, our website is bestofinvesting.com. Check us out on Facebook and hit the like page. And YouTube also by typing Best of Investing Radio Show. Also on Comcast, Channel 26 and AT&T UVerse 99 on Saturdays at noon and Sundays at 6 p.m. And I'm going to turn it right over to Mark because you've got some exciting news to tell us.
Well, I don't know about exciting, but the media these days is all about, records being broken, prices are up, and, in this week's headlines was, 30-year mortgage rates post the largest weekly increase since 1987. So we broke a 25-year record of weekly increases.
Of course, it only had to go up like 10 basis points to make a huge percentage increase.
823, but who's counting?
Okay. Is that how much it was?
Yeah.
Well, Rob,
No,
where are we?
it can't be.
Because this one says, this particular headline, which is now a few days old already, says fixed rate averages nearly 4.5% in the latest week on worries the Fed could soon
Right.
end the stimulus.
Right.
Yeah.
Well, so what we saw specifically was, prior to May 1st, you were looking at 30-year fixed rates about 3.5% on a conforming loan.
Yeah.
And now, if you were to enter the market, that same product might vary between 4.5% and 4.75%, depending on the day. And last week was especially volatile, and the weeks leading up to it weren't too bad either. But when somebody cries fire in a crowded theater, rarely is the exit orderly and and people get out safely.
Sure.
So that's what we saw, and I do think that over time that will settle in, but certainly the increase was rapid and dramatic and caught a lot of people off guard.
Yeah, the poor folks that were in escrow and needed to close and didn't have a locked rate.
Yeah,
that just could really upset. You could lose a deal, lose your deposit, and all kinds of.
Yeah,
this
this is the first sort of change we've seen in a long time. 2003, 2004, we saw a lot more volatility with the Fed statements, but that kind of settled in. But what's hinging on this is far more macroeconomic. The stock market has been a big beneficiary of the Fed's policy as well. We can't forget that. And the policy has been in place for so long. So any talk of removing it or tapering it or anything like that has far-reaching implications. And when they all converged on the Fed's comments that one day, a lot of people were surprised by that. And the after effect of it ended up on our rate sheets.
Well, I find it interesting that Bernanke has taken a lot of heat in some media outlets over the last couple of years for his loose money policies.
Right.
And now he goes and says what everyone expected him or should have expected him to say. Ultimately, he says it, and the crowd goes wild.
Right.
and he's catching flack for it. I'm seeing
Right.
cartoons and and political commentary about that. So
No matter what he says, someone's going to be upset with it. Somebody's not. It wasn't expected at all.
Yeah, the other thing about all of this is that you've got a situation where an economy is dependent on a lot of these policies, across the board. I mean, the jobs number that touched all this off at the beginning of May, April's jobs report, 165,000 jobs created. That's not earth-shattering. That's not fundamentally changing the economy. But is it a step in the right direction? Yes. So that was the beginning of this sort of end play here, where people felt, well, hey, if we keep getting these jobs numbers, that's a sure sign the economy is improving. Is that enough for the Fed to change its policy? And the Fed wasn't exactly clear about that.
They didn't.
So that's what you've got going on. A lot of conjecture. I don't believe the fundamentals, and I think the GDP report supports this. I don't think the fundamentals are there to support any sort of tapering anytime very soon.
Do they expect the interest rates to go back down? Or do you think that at least this upkeep to 4%, 4.5% is
I don't.
new norm?
I don't
Maybe
think. Yeah, I don't think this move is permanent. Whenever you see a dramatic, I mean, when you look back at 2008, was that stock market move permanent? No, of course not. You know what I mean? It bottomed out, but it recovered, and I think the bond market will do that as well. I do think that what has to happen now is that it's much harder to gain ground back than it is to lose it in mortgage rates. So it will take some time before we see any improvement. I do believe they'll come down again.
You're a very smart guy there, Robert. Are you
thanks.
going to be running for Fed chairman pretty soon?
No, I don't think I have
Actually,
skin that
that's-
thick.
He's
but,
thinking about
you know, I
resigning.
get.
He's talked about not continuing with his term. I think his term ends in a year. So.
You touched on the most important point, which is that the Fed he can't please all the people all the time. So some people are obviously going to take it the wrong way, and the market mentality, the herd mentality always persists, and I think we saw a lot of that last week. I'm not a pessimist about where rates are going.
I'm not either, and if you look at a graph over how rates have trended over the last 5 years, we've had, it still has continued to trend down.
Correct.
With a few upward
Correct.
corrections, then another downward path. I wouldn't be surprised over the next 6 months that we maybe not hit the current low
Right.
that we hit in May, but that we actually see
You have
something
recent
above
history
fours,
on
high
your
threes,
side. Yeah, you do, because I mean, we have seen upticks. We saw the last one that I remember prominently was 2012, the very beginning of the year. And a lot of people's forecasts were changing right then and there, saying, this could be the fat lady singing, and we might be done with this low rate environment. And again, later that year, we touched on new lows. So
Well, it's interesting. What's the 10-year at now? About
2.5, right around there.
2.5,
Yeah.
and what was it about? Wasn't it like 1.6?
yeah, it was-
Something around
right.
there.
I mean, you're
Definitely
talking,
below.
that's a 50% increase.
Well, let me ask you this.
over
So
whatever.
what would your take be on that for investors? So, a month ago you were earning 1.6 and now you're earning 2.5. You have to assume at some point buyers
I'd have
will
a
come in.
parade.
So I think that there's a lot of that's yet to happen too.
Yeah. Well, that's true because the difference between 1.6 and 2.5 percentage-wise is huge.
Huge.
But
But
in
not-
reality, yeah, I can't.
Right.
So instead of just peanut butter on my bread, I can have peanut butter and jelly.
Just a little jelly. Don't get too jealous.
Yeah, thank
not,
you.
Not
Yeah,
too much.
Thank you,
Dogs
Catherine.
get
for keeping-
slower.
Excited here.
That's right. Thank you, Catherine, for keeping it in perspective. Okay, we're going to cut to a first commercial break, quick one here. And the trivia theme is colors. What color do you get when you mix red and green? Go back to your old Play-Doh sets when you were a kid, or finger painting, as I remember. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. What color do you get when you mix red and green together? And spell out your email one letter at a time. And don't touch that dial because the best of investing will be right back. Good. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hoff of Pacific Private Money, Catherine Harris of Parati and Karad, and Robert Spinoza of RPM Mortgage. When we cut to the first commercial break, we ask this trivia question. What color do you get when you mix red and green?
Purple?
No.
No?
Next.
I would have said purple too.
No.
Wait, I have to.
Like the price is right. I'm going to say yeah.
I was going with. I think you're wrong.
No.
Blue?
No.
No.
Blue's a primary color.
Oh, that's right.
You get brown.
Oh, I don't think.
I think so.
That's a financial question because green is money. Red is when you're in the red.
So
and you're in the you-know-what when you have
You're in the brown when
Exactly.
Something like that, yeah.
Okay.
Best of investing, right?
Well, maybe next time you will get the right answer.
Taking you back to kindergarten class.
That's right.
Best of investing.
Apparently, we all need to go back.
That's right. And remember, the answer wasn't chartreuse this time.
Okay, next one.
Robert, go ahead.
Yeah.
You're going to continue on.
Oh yeah, we were talking about the increase in rates, and so I think to put things in a little bit of perspective, I was doing a little bit of back of the napkin math before the radio show began, and what you would think would happen in something like this is you'd get a certain percentage of buyers or potential buyers who would say, okay, well, rates went up a percentage point, I'm out. I can't, it's too expensive anymore. Let's remember a few things. One is, even if we're at 4.5% on a 30-year fixed loan, we are at least 4 percentage points below the 40-year average on that same product, which hovers right in the mid-8s.
Yeah, that's
Okay?
right.
So going back
Good
to
point.
1971, you're still well ahead of the game. You don't have history on your side if you're going to opt out because rates are too high. Second thing is, if you have, let's say you have a $1,500 rent payment right now. Give me an idea of how much rent could go up per year. 3%? Is that acceptable?
Yeah. 2, 3.
Oh, okay. Well, if you have rent control. But
If you have, yes, well, then it's
But let-
in the less than 1%, but generally we'll go 3.
Okay, so let's assume it goes up 3% per year.
that's $50, $45.
$45. So in year 3, what are you paying? You're paying $1,639. Okay?
All right.
So if you take a comparable mortgage payment and it goes up 1%, you go from $1,504 to $1,697. You're at parity, and that doesn't even take into consideration the tax benefit.
Now that's assuming that the bank is going to lend you the money.
Well, of
Right.
course, of
Okay.
course, and
Right.
then we have to assume that these people are prospective
Okay.
buyers. So I think that any conversation about housing and interest rates needs to also take into consideration the alternatives. And when that alternative is rent, I don't think it's fair to do a comparison where you don't look at the overview of all the things that would happen if the economy continues to improve, quote unquote improve, and that is the driver of higher rates.
And then you also have the tax benefit,
Right.
right?
Right. So I still think you're making a strong and convincing case for home ownership, if only based on rates alone and in a vacuum.
But we've
But they did, I mean, that 1% interest rate has a substantial change when you're looking at a house that
Yeah,
was
$1
within
million.
reach.
On a
Yeah.
$200,000 loan, it's $118 a month difference.
Yes,
Yeah,
but
that's
on
a $200,000 loan.
Exactly.
$2 million loan.
And somebody
Well-
who's getting a $200,000 loan,
Correct.
that
That may be
$200
significant.
can substantial.
But we want to
And
put that
again,
in
the bank
perspective.
may or may not, based on that.
Right.
Right.
One other thing, actually, I think you're going in this direction, but you're talking about qualification. So one other thing that listeners need to be aware of is that there are going to be some dramatic changes in January of 2014 with the way mortgages are made. And the qualifying mortgage, the QM, which is being propagated by the CFPB and the Dodd-Frank bill and all that, are going to limit...
Too many,
was that?
too many initials.
Right.
Sorry.
Okay, go ahead.
What you need to know is that it's going to limit the debt to income ratio even further for even qualified buyers. So
Okay.
if you're in the market now, you still are dealing with this great confluence of availability in many cases and great interest rates and property values that have not returned to where they were at certain other points in certain areas. So yeah.
Well, I did touch on taxes, so I just want to, since we have a CPA
Yeah.
here, I do want to
Can't ignore
ask her
that.
this question. In your opinion, your professional opinion, and then
Yes.
none of us has the crystal ball. What do you think that Congress? You always say what is IRS, but the IRS is really
It's Congress, right?
What does Congress?
They
makes the
can't
rules?
control much.
Yeah, that's right.
Besides
Especially
who-
nowadays with all
besides who
the
can
parties
be-
and stuff that they're doing.
And
What do you think Congress will more likely than not do with regard to the home mortgage deduction? I mean, do you think
You
they're
know what?
gonna
They've been
change?
talking about that for years.
Yeah.
I think it's something that talk about a profound impact on home ownership. That is
Yeah.
that is a huge.
Well, they did do it with like the $1 million.
Right.
They put a
huge
threshold. It is
subsidy.
It's a subsidy. It is something.
It does prop up prices.
Yeah.
to a
It
certain
is.
extent.
It is a important item that the government wants. They want people to own homes. So to take away that benefit will have a substantial impact. You could almost start figuring out the percentage. It's a substantial percentage. I mean, I would imagine not 1%, but a good 3, 4, 5% return, where at least your interest rates, the benefit of less taxes is a good 2,
Sure.
3%
But-
on your income,
Okay,
generally speaking.
So probably they won't get rid of it, but do you
No.
think they'll make it?
I think they're going to phase.
face something like
Yeah.
if your income's over so
Right,
much.
right.
They may start
you know,
doing
then-
more and more of that.
Yeah.
So Robert, I want to touch on what you said. I agree with you. The 40-year average for mortgage rates being in the 8s, and so those of us who've been around for a while, we remember what it's like to have interest rates that are significantly higher than
Right.
we have right now. But here's the thing, in the first half of the 2000s, we had easy money
Right.
and cheap money, and that drove prices through the roof, where
Right.
they peaked, of course, in 2006 and 2007. And now, we're still substantially lower than that peak, but here we're talking about it's been quite a while since we've seen mortgage rates, in those areas in
Right.
the 5s and 6s
Right.
and 7s. And so what my concern is, and this is where, we've got so many variables involved in real estate prices and where real estate's going to go in the next 12 or 24 months. And here, certainly, increasing mortgage rates is absolutely going to have a dampening effect on the ability to increase prices, because prices, I think, for the large part, even though they're nowhere near in many markets where they were in 2006, is still at a price that for a lot of people, they're not going to be able to afford.
Inconsistent
It's not
with income.
achievable.
Inconsistent
Yeah.
with income
Right.
and with new underwriting guidelines.
You touched on a key element there, and that was the financial industry did a great job in the early 2000s of creating product to enable and facilitate the ever increasing price increase.
Yes.
So you could get an interest only loan, you could get a negatively amortizing loan, you could do all of
You
these
could
things.
afford it. They made an instrument so they could afford it.
teased
You could access it. You could not have maybe afford it, but
Very
you could.
correct.
But you could
Yeah.
access. So that's gone. And you're right, Mark, because those buyers and borrowers they're out of the pool already.
Yeah.
They've taken their towel and gone home. So what we're left with here is a discussion, I think, and I think every listener out there is probably thinking this about a bubble, where
Yeah.
what's going on with. And one thing you have to remember with when you're talking about a bubble is, it's driven almost, I'm not going to say entirely, but largely by psychology. And right now we've had this momentum here locally anyway, where
Yeah.
you've got prices increasing and you've got pent up demand and you've got low interest rates. Now we've finally had one element, one leg of that stool has been kind of kicked. And it will be interesting
Yep.
to see how the consumer, the potential buyer, views that.
Well, in some cases, they may go, uh-oh, interest rates are going to go up so
Correct.
much, I better quickly.
They wanna do
You,
now.
you will have a rush in,
Multiple
right?
of them.
But
right,
if you've
right.
seen some of the articles lately, who's the people who are buying these properties? Who are they? They're
Investors.
mostly investors.
Yeah, there are.
I-
Mark could speak to that.
I've been looking at buying a house myself, and I go and, do you have 100% cash down?
Right.
No, I don't.
Even if you have 120% cash, sometimes
yes,
you can't buy it.
exactly.
Right.
And also, what they may not point out is though our unemployment rate has been going down, it's the type of employment that people
Yeah,
are
very good
receiving
point.
and their compensation.
That's a good point.
People are not necessarily getting the compensation that they were receiving before the
You know,
recession.
that's a very good point, because if you're a
So-
PhD making $100,000 a year and you've been unemployed for a while, and then suddenly the only job you can get is at Starbucks, suddenly you're back employed.
You're on the
right?
roll.
Yeah.
Yeah.
And you don't have to,
Yeah.
and you're counting
Yeah.
that. But even if you say you got another PhD job, but they're only going to pay you $80,000.
Yeah, that's
so
a very good point.
you're going to be entering into the market, but you're not going to be entering where you once
Yeah.
were. And then the market rates are going up, and this bubble, the prices are increasing. And again, it's usually, from my perception, it's got to be investors are pushing this
Yeah.
current bubble that's going on.
To some degree,
because-
certainly.
Very good. Okay, we're going to cut to a second commercial break. When we come back, we're going to get into email time. We've got a lot of very good emails for our hosts here. Our co-hosts, as they say. Okay, what color do you get when you mix red and blue? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. That's 888-912-1190 to answer this question. And no, the answer is not chartreuse. What color do you get when you mix red and blue? I should have given you guys all finger painting stuff so you can actually do it here. Call 888-912-1190. Make sure to include your name, your email address, speak slowly, spell out your email one letter at a time, and we will be right back. Welcome back to The Best of Investing. I'm Edwin Brown, your host, along with our co-hosts Mark Hunt, Catherine Harris, and Robert Spinoza. When we cut to the second commercial break, we ask this trivia question. Again, the theme is colors. What color do you get when you mix red and blue? And now the answer is
Purple!
oh, that is correct. Okay, we're going to get right into email time. Catherine, let's start with you.
Please.
Do you favor a national sales tax?
I'm open to it. Though I
Okay.
do think no matter what type of tax we have, whatever national tax we have, whether it's income tax, a consumption tax, there is going to be the conversation of fairness.
Okay. I mean, like progressive or regressive
Right.
type?
Yes,
Okay.
yes. And I'm definitely open to like a sales tax or a consumption tax where those people who utilize or choose to buy the $1 million home or buy the Lamborghini get
Yeah.
to pay more for that, the
Well,
use of that.
And you don't necessarily have to have the rate increase. I mean, if you have let's just make it simple, a 10% sales tax, and you buy a, $100,000 car, you're paying $10,000.
Right.
People who are poor aren't going to afford a $100,000 Lamborghini, so they're not going to, have to pay that kind of
Correct.
tax.
I'm open to it.
The problem with, discussions of a national sales tax or a flat tax is that the people that are behind that and that are running for office are usually unelectable. Number one,
Yes.
The
the
Green
Steve
Party.
Forbes of the world, and then secondly, we all know that tax policy is a political weapon.
Right.
That's all it is at the end of the day.
And if the country is run by Congress, they're not going to give up that power.
Right.
Well, here's the other thing: is that does it hurt the economy because people then are going to be less likely to spend versus when they used to have in the old days before all of you were born and I was the old man here. Of course, Mark's a month older than I, so I don't have to say
So
that
when
anymore.
you two are there.
Yeah, it was when they had the investment tax credit. And so they gave an incentive for purchasing equipment.
Oh, I see.
So, there were a lot of companies that went out there and spent lots of money to buy equipment that helped the economy.
Right.
And so if you take away that kind of incentive, i.e. a national sales tax, where's the incentive?
Well,
for
that
people to
discussion
spend?
comes up on a lot of this, and Mark, I think you touched on that too. Is that tax, in addition to being a political weapon, it's also a way to influence behavior.
Well,
It's the
absolutely.
policy.
So
They
you
can control.
right. So I think you bring up a great point, Edward. Is how do you get tax policy to represent what you'd like to do to
Right,
improve the benefit
influencing
of the country.
consumer behavior,
Right.
public behavior,
Right.
public good, green
Right.
policy.
Right.
Exactly.
There's
It's
a lot
just
of things
it's
you
a-
can do well with that kind of policy.
It's a tool that they have
Yeah.
in their.
Now
Toolbox.
Europe has
Yes.
correct me if I'm wrong. Europe has income tax as well as a sales tax, correct? I think.
Well, they're very socialist, so.
Yeah.
Their income tax is very low. What they have
Oh.
substantially is an estate tax.
Oh.
Their estate tax, when you pass away, that's when they get you. I believe that is
So don't die,
substantial.
Joe.
Well, that doesn't
Yes.
bother me all that much.
Yeah,
Yeah,
if I'm
exactly.
dead by
At some
then-
point, when you're dead, you're like,
You gotta work
fine.
for your
Fine.
food.
You know,
Work
yes.
for your food, yeah. Well, but off air, Catherine, you were saying that one of the incentives, though, is that people will have a higher paycheck because there wouldn't be income taxes
Oh, good
taken
point.
out.
Yeah.
Exactly. So where people would be not interested in buying products, be consumers, because the purchase price would be higher, they also would have more income in their pockets because they're not paying for some individuals. But they make that I can't remember what the percentage is. I believe they say more than 50% of the citizens of our country do not pay income taxes.
Yeah, right.
So to them, they will have a negative impact immediately,
that's a
even
good
if
point,
they're
yeah.
going to buy.
Yeah. I mean,
The-
and the thing is, would you have it on groceries, or
Exactly.
would you,
And then that's where you start to go into, no, we won't do it on groceries and what is considered staples
Right.
Yeah.
of a household, a car, or as it then goes into the threshold, maybe for purchases over $100,000.
Okay. Well,
That becomes a political hot potato all over again.
Again.
Exactly.
well, they've been talking about abolishing the IRS for many, many years now.
If only.
If only.
Forever.
I find that they can find other places to remove federal government agencies first before the IRS.
I know, but after all of the scandal
Yes.
that's been going on,
That would be a good topic for another show.
H.L.
It's,
Mencken is famously quoted as saying, "For every complex problem, there's a simple solution, and it's wrong."
That's a good point. Now, Catherine, you're quite a intelligent co-host, which is why we have you on. How do people get a hold of you? I mean, tell us just a little bit about you
Sure.
and your company.
I'm a manager at the I'm a manager with Parati & Crowd. We're a local accounting firm, full service. We help individuals, businesses, nonprofits with their tax returns. We can also help businesses and nonprofits with any reporting they have to their bank or to the government. And I can be reached at 415-461-8500.
Okay, very good. And Robert, we're going to ask you this question here. I was told that I can only have 4 mortgages and then things change. What's that all about?
Okay. Very, very astute question. So the deal with that is, if you're buying a primary home, then that does not enter into the equation. So let's say you see a piece of property, you intend to live in it. If you own other properties and they have mortgages on them, that is not a limiter. That comes into play when you are buying an investment home. So if you own a property, you live in it, and you go to buy another investment property and you have other mortgages on them, then the Fannie Mae and Freddie Mac guidelines will limit your options with that. Many banks have overlays, some do not. For instance, RPM will finance between 5 and 10 investment properties. So it is possible. A lot of lenders have exited that game, though. They overlay that to the Fannie and Freddie guidelines, and they say no investment properties, no more investment properties once you go over 4.
And the reason is because of the domino effect potential?
Yeah, exactly. And the other thing about that is that if you own the investment property and it's free and clear, that obviously doesn't count. Because when people build up a portfolio, you tend to see, some of those properties will be paid off, or the borrower, and I've done this for a number of borrowers, can potentially take all these rinky-dink $30,000, $70,000 smaller mortgages on all these properties, consolidate them into one.
Oh, yeah.
And now they're back in the game again on their investment. So that's how that works. Can be a little complicated. Some other investors have some other weird things where it's just properties owned, but by and large, that's what that's talking about.
So Robert, do you see the banks coming back into the investment property market in any significant way? Because right now, one of the reasons why my hard money lending brokerage is doing gangbusters is because banks, for the most part, aren't making many real estate investor type loans. But do you see that? Do you see that changing or coming back?
Well, I think there's a few components to that. One is a lot of times if it's an investment and someone wants to grab it, the property might not be in condition to conventionally finance. It might be missing floors or need a lot of work, and it's not going to appraise. And appraisal regulation was also hit in the meltdown. It's much more stringent. So you're going to see those investors have to go look for an alternative source of financing. And then the second thing is that a lot of your borrowers are just going to find that it's it's not what they want to do when it comes to investment properties in terms of the rates and the differences on that.
Okay, we are going to cut to our third and final commercial break, and don't touch that dial, audience, because when we get back, we have a very interesting email question from Mark about earning high rates of return, and want to touch on gold a little bit. How smacked down it got. Okay, here's our third and final trivia question. What color do you get when you mix yellow and blue? The first 3 callers with the correct answer are going to win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Again, make sure to include your name, your email address, speak slowly, spell out your email 1 letter at a time. Don't touch that dial because we're going to be coming right back. Okay. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money, Catherine Harris of Parati & Karad, and Robert Spinoza of RPM Mortgage. And when we cut to the third and final trivia question commercial break, we asked this question. What color do you get when you mix yellow and blue? Anybody?
I know.
Green.
Green! That is correct.
That's a chartreuse.
Good job.
There's your
Chartreuse, right?
That's right.
That's there's
I'll think of
It
another.
does depend
Are
on
we
how
out of
much
questions?
green and how much
That's
yellow
right.
you're
That's
putting
true.
in it.
That is true. 'Cause
It's
you can have
Holiday
yellow,
Inn's.
green.
Holiday Inn's color is chartreuse. Did you know that?
No.
Yeah.
No.
No,
Yeah.
that's green.
Yeah, isn't it weird green? Yeah.
Not really. It's normal green.
I thought that was chartreuse.
Okay, but before we cut to the commercial break, though, we forgot to find out, Robert, how do people get a hold of you? Because you got all the mortgage answers.
Yeah, so I'm happy to help. I'm located in Mill Valley, California, and phone number is 877-270-5959. Yeah,
Very good.
Happy to help.
And also on the Best of Investing website.
Also on the Best of Investing.
Which
yeah.
reminds me, Catherine, we have to get you
Yes.
pictures and bios and all that stuff on the website.
Get a mugshot up there.
On my to-do list.
On your to-do list. Okay. Mark, here was the email we received for you. In today's ever-changing rate environment, can you still maintain an average of 8% return? This must be a listener who's listened before.
Indeed. So my company is Pacific Private Money. We're based in Marin County. We're hard money lenders to real estate investors, also sometimes referred to today as a private money lender. It's the softer
Yeah,
name now, yeah, because
Kindler, gentler machine gun
Kindler,
hand.
gentler
Yes.
lender, right? So anyway, so we make privately funded loans or hard money loans to real estate investors, mostly in the Bay Area. That's one of the
Saw one in San Jose though recently.
Yeah, one of the characteristics of hard money is it tends to be local. In other words, we're using private capital from investors who live in the Bay Area, and they've grown attached to the fact that they can make very, very high yields on their savings by investing in notes that are secured by real estate. And so at Pacific Private Money, we do two types of investments. We have folks that directly invest in a note. Sometimes that's referred to as trust deed investing, and that's where your name actually goes on the loan and on the deed of trust and on the insurance policy and all that. And you make that loan. Of course, we underwrite it because we're a licensed California real estate broker. We collect the loan application, we do the background check and the credit, and collect all the financial information. We look at the property, we do the appraisal, we do all of that stuff, and we're regulated, so we have to provide loan disclosures. Our loans are like a bank loan, so
Right.
they're, in fact, the regulations are such that nowadays when you get a loan from a private money lender, if they're doing their job correctly, and we'd like to think we are, there's as many pieces of paper to sign on a hard money loan as there are on a bank loan when you buy a house. So it's regulated, and really the only difference between the loans we make and the loans that the banks make are that our money comes from private individuals. We don't go get it from the Fed window.
Right.
So, and one thing that's really interesting about private money / hard money over the last 10 years is there hasn't been volatility in the pricing. I mean, if anything, it's come down a little bit,
Right.
but 10 years ago, 12% was not an uncommon rate for a hard money loan. Today, you can still pay 12% on a hard money loan depending on the situation, but it might be 11, it might
Right.
be 10, it might be 9,
Nine,
but it's
yeah.
not likely to be 8 or 7 or 6. It just, and the reason for that is that, private individuals,
Are greedy.
No.
No, just kidding.
They're taking the they're taking the risk.
Oh, of
And
course.
They're making a loan to a
significant
complete
risk.
stranger.
Well, but not
And-
necessarily though. Because they're getting a mortgage-backed
Backed,
promissory note.
Yes.
And the,
Correct.
and the LTV is not going to be 99%.
Right.
It's going to be closer to what?
60, right?
Yeah.
Even that.
65, 70%.
Yeah.
Well, Edward, you bring up a good point. If I had a stable of investors that were willing to make their money available to me at 5 or 6% because
Right.
they thought that was a screaming yield, I could make, lower interest rate
Yeah,
privately
sure.
funded loans. The challenge is that it just that product really isn't available. I mean, there seems to be a threshold at which people will not make these types of alternative investments, and that threshold seems to be right at around 8%.
Right.
That's about the lowest loan I can make.
Well, because it's where there's this perception that because it's not FDIC insured, which, oh, by the way, your stocks and bonds are
Right.
not FDIC
Correct.
insured either, and they have principal fluctuation. Here, all you're doing is investing in a first deed of trust at 60% or less, let's say LTV,
Mhm.
and if anything goes wrong, you can foreclose, just like the bank does.
Right.
So the risk isn't necessarily just because it's a hard money loan.
Right, well, that's exactly right. And so I did mention that there were two products. One is you directly invest in a note, and the second product is we now have a mortgage pool fund, which if you're looking for a passive investment opportunity where you don't have to actually read through someone's financials or go drive by the property
Right.
to look at the property, you leave that up to our team. We do that, and you put your money to work, and your money works for you 24/7. The fund's paying out rates in right around the mid-8s right now, which again is just a fabulous return. I mean,
Sure.
8% return on your money in
And
today's market.
diversified because it's more
Yeah.
than one loan.
Yeah, it's diversified over a pool of loans secured by real estate in the Bay Area. So it's a great way to boost the yield you earn on your savings or IRA accounts. If you have a self-directed IRA, you probably already know about investing in notes because you may even be buying real estate in your IRA, as some people do. But you should definitely consider, if you're not familiar with this, you really ought to take a look at trust deed investing and mortgage pool backed investments as a way to boost the yield that you get in your savings. Because, gosh, we all know, we're all, at least two of us, of the four of us sitting here are boomers and looking at retirement
Yes.
going, we need to earn more on our savings. It's been a wicked last 10 years in terms of low savings rates.
That's a good point because the interest rate that you can earn significantly higher makes a huge impact when you can do it consistently.
Right, over
Yeah.
time,
Years,
that's
yeah.
right. If you can, and that's what's been great about investing in the private lending market is that over the last 5, 10 years, it's been consistent. Now, of course, there were folks that were making loans. If you were investing in seconds when the market crashed,
Yeah.
no. So it's not that you can't lose your money. You can, but if you believe that real estate we've had the adjustment, the air's been let out of the balloon.
Right.
Unless if you're one who believes we're going to go through some massive market correction again, then you're probably not a person who should be investing in notes.
Right.
Although if it's
Right.
first position and well secured, your exposure is limited. But certainly seconds are not very popular.
go ahead,
these days.
Catherine.
Now, do you guys provide some type of assurance to the investors? Do they get audited financial statements from you? Do you provide, obviously for the one product that you offer where they are the individual investor of one specific property, but for that second product where they
The mortgage
are
pool
the
fund
pool
is an
funds.
annually audited product. So yeah, audited financial statements are a requirement of the fund.
Wonderful.
Yeah, it's a
So that
regulation of the
provide,
fund.
people just need to be educated the difference between something that is government backed
Yeah.
or have the perception when you are in you said bonds aren't, and obviously stock are
Sure.
not, but they for
Right.
some reason have this perception that they are a
Safer.
more secure
Yeah, more secure, yeah.
investment. That what they have to go through is very similar, if not the exact same,
Yeah.
that you have to go through. And actually, I bet you.
Well, and I'd personally rather have money invested in real estate backed assets because, as Will Rogers said, they ain't going to be making any more.
Right, right.
Those are land specifically.
yeah.
But just in general, it's like someone has an investment property, and if you're a first mortgage and you're only at 60%
Right.
LTV, you're only going to lose your money if that property drops,
Substantially.
Yeah, and so if that's the case, then we may have more problems than just
Right,
that.
right.
You're talking Armageddon at that point. In fact, it's funny because for many, many years I did hard money loans, and the loans that I did, in some cases, now I didn't really honestly do this, but in some cases I was kind of like, I sure hope that the borrower doesn't pay me.
Right.
Because
right.
I want to
Property,
foreclose.
Yes.
I'm gonna get smoking hot deals
Right,
here.
right.
And in fact, I actually did have to do a few foreclosures, and those were the best days
Properties,
of my
yeah.
life. I still
That
have
was a bonus.
It was a bonus.
It's-
I actually made more money by
Yes.
foreclosing than I did by them just paying the
You're paying the
regular
note back.
interest. And of course, I don't have one of those mustaches where I put people underneath the railroad tracks. I just was, I was a very nice lender, but sometimes things just happen. So
They call that loan to own in
Yeah.
the business, and I have
That's
some
funny.
clients who actually like that idea.
Those scenarios.
Those
They-
scenarios, they
they
will
actually
actually
approach
lend
with
their
that.
money when they believe that they might end up foreclosing.
Sure.
And I've got a couple of clients that their entire portfolio of real estate they got by foreclosing. Now, that sounds a little
Patiently
wicked,
waiting.
and most of my clients are not like
no,
that.
but they're not forcing the issue. It's
They're
just
not.
circumstances happen.
Well, you know what's interesting about that when you talk about servicing rights on a mortgage and all of the Wall Street people that look at servicing rights, when you think about certain components that make servicing rights more or less desirable, you can very quickly get into those inverse scenarios because in a servicing environment, if you have a super high loan to value like they do on the HARP loans,
Yeah.
those people aren't going anywhere. So unless they default, they're not refinancing. So you've removed the two things
that's a good
that
point.
harm the servicing value, which are payoff,
Yeah.
i.e. refi,
Yeah.
or default. You've
Interesting.
taken one of them off the table.
And before we cut out of here, I wanted to really quickly go over gold because it dropped to $1,220 an ounce.
Ouch.
And this one researcher guy says the fair market value should be closer to 800. And the interesting thing is that when you make comparisons, like back in the day of a Roman centurion, his annual salary was about the same as what a U.S. Army captain in relative
Okay.
terms. The annual pay is almost similar. A U.S. Army captain makes about $46,000 a year. The Roman soldier or centurion made about a third of this, he had around 39 ounces of gold annually. 39 ounces works out to be at $1,220 an ounce, $47,000.
You know what's so funny about that is that
Something.
I heard an analogy about gold. Is they said in the 1920s, an ounce of gold would buy you a nice
a
suit.
Same
Yeah,
thing now.
exactly. And same thing now.
One quick thing too is that this research shows that gold is a good store of value over thousands of years. The problem is nobody lives quite that long. Okay, and let's see. We're going to cut out here. So here's our thoughts for the day. The optimist sees opportunity in every danger. The pessimist sees danger in every opportunity. Which one are you?
I know the answer to that.
And Winston Churchill said, if things seem under control, you're just, oh no, I'm sorry, that's what Winston Churchill said that. Okay. Now, this was said by someone different. If things seem under control, you're just not going fast enough. By Mario Andretti. Tune in next week to The Best in Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening, audience. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.
Wow, that was close.
Yeah.
Cool.
Perfect.
Now what are we talking about?
Yeah, yeah.